Hey guys, Joseph Henson here with Henson CPA Group. I appreciate you showing up this week. And this week we are going to talk about understanding your S-Corp taxes. Owner compensation done right. You don't want to just put this to the side and worry about what everyone else says. We want to make sure what's happening for your business happens for your business. I don't care what your cousin down the road does. I care about what you do. Unless your cousin down the road is also my client. Again, I'm Joseph Henson, CPA with Henson CPA Group. Thank you guys for showing up. We're going to jump right into it this week. Why ownership compensation matters. S Corp owners must take a balanced salary versus distributions. Incorrect compensation can trigger IRS audits or penalties. Proper planning optimizes tax efficiency and retirement contribution. It will also help avoid federal taxes while staying compliant. Let's start with reasonable compensation defined. The IRS requires an S corporation owner to pay themselves a reasonable salary for services rendered. If you own an S corp, say you're 30% and your business partner 70%, but you don't work in it, you're not providing any services, you don't have to take a salary. You get distributions. Say you are taking providing services, especially for you all, you're area, you're providing services daily, you have to take a reasonable salary. And this will include the clinic side of the revenue, the owner duties and time spent. So if you spend 20% of your time on administrative work, 20% on HR, and 60% on veterinarian day-to-day work, you have to make sure you factor that in correctly. And then you go based off the industry standards. The goal here is have a high enough salary to satisfy the IRS, but low enough to maximize distributions. I see a lot of things out there, 70% to salary, 30% to distributions, 50-50. There is a formula here. That's what we really want to worry about. What is a salary versus distribution? A salary is subject to payroll taxes included on your W-2, while distributions are not subject to payroll taxes for S corporations. These are reported on your K-1. There's a reason your corporation has a tax due date of March 15th. If you have an incorrect split, it can trigger IRS penalties and you can leave money on the table. We want to make sure we take the highest allowable salary, the lowest allowable salary, to take advantage of the fact that you can pay no self-employment taxes on the distributions. Finding the right balance is key to tax efficiency. The owner compensation, you know, a lot of times you hear 50 to 60% of net income or a regional market. The distribution should be the remaining 40 to 60%. But we don't want to just apply that and say this is what's going to work. We want to do a reasonable compensation study because we want the proper balance to minimize payroll taxes while maximizing your take home pay. Common mistakes that owners make is paying token salaries too low to avoid payroll taxes. Well, I was told that if I pay myself $30,000, then I can take out $160,000 as a draw. I was told if I do this, then this. That's not how this always works. We want to make sure there is a reason for your salary. On the other side, overloading salary and leaving little for distributions. We don't want to pay out a $500,000 salary but not take any distributions. We don't want to pay out $200,000 in salary and take $20,000 in distribution. We want to find that sweet spot. Yes, that might be if you have $200,000 in income, taking out your salary, that might be 100 and 100. That might be 80 and 120 or 120 and 80. We need to be sure that we're not doing, that we are doing right. We don't want to ignore the industry benchmarks when setting compensation. That is a huge mistake that we see periodically where folks are like, well, I'll just do what I want to do. I don't care what my colleagues are doing. I need to do what I want to do, whether that's paying yourself too much or too little. We want to find that happy balance. And then forgetting to adjust salary annually based on clinic growth. If last year you did $1 million in your clinic, and this year, or I'm sorry, if 2 years ago when you set your salary, you did $1 million, and last year you did 1.3 million, your salary is not reflective of what you did when you set your salary in 2024 instead of 2025. So we want to adjust that in 2026. Not doing that will hurt you in the long run because if you pay yourself too low of a salary, you can't necessarily put as much to retirement. Planning for retirement and benefits. Speaking of retirement, your salary will affect retirement contributions like your 401k, a simple IRA, a solo 401 if you're a solo practitioner. Not having a high enough salary will greatly diminish how much you can do. Distributions don't impact contribution limits. If you make $1 million in profit a year, we're gonna go huge, but you pay yourself $50,000 in salary, that other $950,000 you took as a salary as a distribution does not impact how much you can contribute to your 401k. We want to optimize and take the most we possibly can. And then proper planning will ensure maximum tax advantage savings while staying compliant. We want to maximize what you can put away now to defer taxes, especially if you're a high income earner. We want to defer taxes potentially rather than put as little as possible in. If you were making $200,000 a year and you're not putting away the maximum you can into your 401k, we want to talk about that. How to adjust compensation annually. You need to review profitability and revenue growth. Yes, you're going to use last year's numbers to calculate this year's salary. We have to because we don't know what's going to happen this year. We have to base it off last year and assume we're going to grow. We want to compare to industry benchmarks. If you are a veterinarian and you have a senior associate who makes $150,000 a year, and you're paying yourself $100,000 a year, but you're working the same number of hours they are, you're paying yourself too low. This is a competitive wage. Now, I'm going to add to that $100,000 to say if you're only spending half the amount of time they are on surgeries, clinic work, because the other 40 hours or part of 40 hours is spent on administrative work, um, support work, HR, yeah, your salary might be lower, but we want to make sure we know what's happening. You want to update salary to reflect your owner's duties, your time commitment, and the market standards. There is a formula here. This is something we do all the time, but you have to take a lot of things into account. Adjust your distributions accordingly for optimal tax planning. The benefits of getting it right. You will avoid IRS scrutiny. Not for everything, but at least over this. If you get it right, IRS scrutiny. You do a reasonable compensation study with us or someone else. The nice thing is, if it does get scrutiny, you can give them a stack of papers saying, here's how we calculated this. They look at it, great, thank you, have a great day. If you get it wrong, they can say, yeah, cool, your salary was actually too low. So we need to amend last year's filings for payroll. We're going to reclassify some of your distributions to payroll, and now you have penalties and interest for not paying these timely, and you pay a lot more money to amend it. Getting it done right the first time will help you tremendously. Getting it right will allow you to maximize your after-tax income. The goal of anyone is to maximize their take home. What does that truly mean, though? We want to maximize our take home in a way that will allow our after-tax income to stay in our bank and not have to go back to the IRS. We want to make sure we can maximize this through credits, through retirement contributions, through distributions. Doing it right will save you tens of thousands of dollars. It will also allow us to plan effectively for retirement and personal finances. Too many veterinarians I've known are like, well, I'm living like I'm poor. I don't have money. I live paycheck to paycheck. I make $300,000 a year, but I'm living paycheck to paycheck. What's going on? Yeah, there's a spending habit. We need to adjust here. You're paying too much in payroll taxes, which is hurting your distribution. So you're immediately losing 15%. let's figure out what we can do here. It will also let you have maintain financial clarity for strategic decisions. All of your business decisions should have the financial impact. They want clarity. If you're just throwing a dart at the board, you're going to just hit something that is not what you want. We want to make sure you know where your company is going, and a steady cash flow with salaries and distributions allow you to personally prosper, but your business as well. If you want help reviewing your S-Corp compensation structure and ensuring your clinic pays the right salary while optimizing distributions, just get a hold of me. My email's on the screen. There is a link below that you can click if you're watching this live. We love going through this. We can set up a time to do a reasonable comp study to figure out where you should be. But again, I appreciate you being here. I'm Joseph Henson, CPA. My email is joseph at hensoncpagroup.com. My website is hensoncpagroup.com. Love hearing